Hello, good morning. And today is the 4th of January. Happy New Year to everyone. Well, we shouldn't really take too much time about what happened last week, but we've got time to discuss what the possibilities for the first quarter are. So, Andy, do you want to kick us off and tell us what you saw last week, if anything? And we'll very quickly go to what is probably going to happen in the first quarter.
Sure. When you look back over the course of the last 3 months, equities, except for the Mag 10, performed pretty badly, really making no return on the S&P 500 overall. There was a little election bump, but really not much stocks underperformed cash. So what was notable over the last quarter, and Friday ended about where, at the worst, was the continued sell off in interest rates, where interest rates on the 2 year are near their highs, and interest rates on 30-year bonds are at their highs since for 2024. So I think the story still remains that the fixed income market is vulnerable because we got warm data, and data has been warm and continues to be warm, and the economy shows no sign of weakening. And we also know that there's continued budget deficits with tremendous issuance, and there's just been no lift to the bond market.
I think the market is beginning to discount that we are at or very close to the neutral rate, that famous thing that nobody knows where it is, but everybody thinks it exists. And if that is the case, what is the market doing? Well, it's pricing in a higher real interest rate via higher term premium. Because if the economy is not going to buckle, well, the only thing that can happen is that the curve goes steeper. And if we say that Fed funds are at 435 and general collateral is around 435, that means that the 2 year note is slightly higher than that. The 5 year note slightly higher than the 2 year note, the 10 slightly higher than the 5s, and the 30 is the highest of all. And we have basically a normal yield curve, which is a good thing longer term because you earn money by just being patient. But in the meantime, you get these adjustments whereby equities just can't go any higher because duration, and equities are the longest duration asset, keeps on getting sold. And therefore, equities just spin their wheels overall, which
Yeah.
is what we've seen for the past quarter.
Yeah, and I want to
As you say,
highlight
no change.
Yeah, I want to highlight what Nick said about that in terms of the yield curve. A lot of people try to try to, and for good reason, try to look at the yield curve as an indication of what the Fed will do. And when it's inverted, like it has been for most of the post COVID, post inflation period, there's an expectation that the Fed is going to cut rates aggressively. Now, Nick said the curve is going to go positive across the entire curve if the neutral rate has been achieved. That doesn't say that you can't take a positive curve and say that means the Fed is going to hike. That's just normal. It means the Fed could hike, or it may not, or it may cut. And so it's and that's neutral. And so the insight that Nick mentioned is that as long if we are at the and again, this is market pricing, not anything else. If we are at the neutral rate, we should expect a curve to be positive across the entire curve. And so twos should trade at a positive yield relative to funds.
And that's what the premium basically is. The higher it goes, the more positive the curve, really. And at the moment, we are taking out the highs of the previous couple of years. And in real rates, we are approaching the 250 level in the tens. And if we go through there and we go to 275, 280, that should be enough to slow down any economy, let alone one which is as highly leveraged as the US economy. So we shall see. Those are the possibilities for the next quarter, for this quarter that we are in. Either we get higher real rates to around 275, and don't forget that the highest we've seen was October of 2023 when we achieved 255. If we surpass that, which would mean that bonds take another leg lower in price, that is not going to be good for equities. At best, they're going to spin their wheels like they've done for the past quarter. At worst, they're going to have a pretty significant repricing. And we will have strategies in place for either possibility. But what we're basically saying is that no one knows. And next week, we get a piece of data which is going to be important in the puzzle, which is NFP. What is going to happen for NFP? Well, again, every single piece of weekly claims has been pretty neutral as expected. So it would be a surprise if this NFP was a big surprise, i.e., very cold or very hot. So probably this is not going to tell us very much about the economy, and we'd have to wait then for CPI later on in January and possibly the politics of the Trump administration inauguration and the first 100 days and the tariffs, because the market could have anticipated quite a bit of inflation through tariffs. This is something that we will have to discuss on a weekly basis going forward because we just don't know at the moment.
Yeah, I agree with all that. We also have the refunding of threes, tens, and 30s next week. Monday, Tuesday, Wednesday. Thursday is a weird day with the stock market closed. There's not a lot of information, but there's some, and certainly on Friday, important information that the market may react to. I'm interested in your outlook on the risk to the bond market. You've been a bond trader your whole life. What we're at a point where everything's pretty, what looks like pretty cheap, but on the other hand, do you think we're vulnerable to a sudden repricing?
Yeah, the bond market loves to spike and then retrace. I think the highest odds, and this is just me speculating, is that we have a spike in term premia of about 30, 40 basis points, which drives the tens reals to new highs, i.e., 265, 270, 275. And then that should be enough because then people will get really bearish of everything, of all assets, uh, mostly bonds, but equities as a result of the bond spike. And you might get a very quick drawdown in equities, which probably is a buy. And certainly I would buy the bond spike because it's just too attractive. At 275 real rates, I think it's very attractive. And I don't see what we have to fear unless we have a resurgence of inflation. And I think that is very unlikely at the moment, simply because I don't think the Fed has cut too deep to reignite it. And all the policies that the next administration is going to have in place. And I have a lot of faith in Besant as a market participant and someone who knows very well what the market is going to respond to and how it's going to respond to his policies. I have a lot of faith that he's not going to put in place policies which the market isn't going to like longer term.
Right.
And
But
that,
I'm more interested in the sort of spider sense that you have, that a drift that whether this will be a drift to 275 or a spike, and why. And it sounds like you're leaning toward a sudden violent
yeah,
drawdown in bond prices.
yeah, I think the likelihood is more towards that. The bond market tends to do little crawl and then a big spike. And that is what I think is more likely. And when could it happen? It could happen on any really hot unemployment number, NFP, or it could happen on a surprisingly high inflation. Either of those would be enough to have a real panic. And when I say panic, I'm talking about a 20, 30 basis point readjustment in a day, that kind of move. And that I think would be enough. That should mark the high or very close to the high. We will see. It's something that it just as you mentioned, that my spidery sense, and that's why I like to be hedged for that possibility. But I'll talk more about it in my piece later on.
Sounds great. So we're leading into this week. We do see bond supply. We do see potential market moving data. Obviously, equities continue to be dominated by strong, but broadly, equities are not doing that great. Is there, when you think about our equity allocation, I still want to be long equities given there is well, we always want to be long equities, but given that there is a very strong economy and what we're saying is until there's a bite where the real rates actually start to affect the economy, and that'll take a lag, equities remain okay to own. I'm only thinking about risk. And so I could imagine at some point we think about using the technique we've described in stock replacement, where you can either sell your stocks and buy calls, and that's conceptually what we're trying to achieve, or buy puts and hold your stocks. And
Yeah.
that gives you a call like payoff. What do you think about that at this stage? Is it time? It feels early to me.
It's a little bit early, I think. I think if next week we have a bit of a rally, it might look attractive. In the VIX and the structure of the VIX says there is no panic at the moment and that we have time. I'd rather wait for either a decent rally next week, or I would like to see what NFP is and decide afterwards.
That
But in
makes
any
sense to me.
case, we can send out a very quick message, because I think the big risk is that we break the support in the equities on the back of bonds. I don't think that equities are going to do it by themselves. I think they have to be driven into a sell off by a bond sell off.
Yep.
So we will have probably plenty of time to advise our clients of what we want to do.
Sounds great. Have a happy new year,
Excellent.
everyone.
Happy New Year. Speak to you next week.